Very good evening, friends. I guess I'm audible.
Yes, sir.
Okay,
Good evening, sir.
great. Good evening. Right, I think we finished with IS 37 in the last session, I think. Yes, that's great. Okay, now what we're going to do today, we're going to start a trail of, I would say, asset-related standards with you. And before I begin with these particular standards, I am going to give you a chain of thought how we are going to actually study these standards, because there is a certain sequence which I think is required to get a conceptual clarity on the standard. So I'm going to give you a list of standards which we're going to cover on asset related. And I'm also going to tell you, how we are going to look at these standards. So let's first give you a list and then give you a chain of thought in terms of how we are going to study these standards. Then we'll begin one by one. So I'm basically going to start my chain in terms of what I call the asset related standards. More or less, the sequence which I'm giving you is what we're going to follow in terms of these asset related standards. We'll start with some simple standards and go on to settle more complicated one. Like we'll start a journey in terms of IS2. I'll just give you the name of the standard as well. It is called inventories. And then we're going to go to the next standard, that is IS16. That's called property plant equipment. It's called PPE. And then we're going to go to IS38. That's intangible assets. The name of the standard is called intangible assets. And then we've got IS 40, that is investment property. The name of the standard is called investment property. And then there is another standard, IS 41, that is agriculture. And then we're going to come to another standard, that is IFRS 5, which is non-current assets held for sale and discontinued operations. That is the entire name of the standard. And then I'm going to take you further to IS 36, that is on impairment of assets. That is called impairment of assets. So that's a very important, crucial standard indeed. There are a few related standards like IS 23, which is on borrowing cost. Now, these are not very pure asset related standards, but I would say more or less quite connected. So we're going to cover IS 23 and then IS 20, that in short is dealing with the concept of government grants. So I guess if you just take the total number of standards, this is a total of 6 standards out here, and we've got another 3. So we've got a trail of 9 standards which are related to assets. More or less, we're going to study these standards in almost a same sequence what I have mentioned. And when you're going to study these standards to get a conceptual clarity, there is a particular way which I feel one should go through these standards. I think if you've taken a note of the list, I'll just take it further. Right? So if you're done with the list, I'll just take it further.
Excuse me, sir.
Yeah.
Sir, what is next to NCA dash?
Held for
Yeah.
sale.
Okay.
It is called HFS, held for sale, and that's discontinued operations. Right. Can I go further? Okay. Now, when you are going to study these standards, any asset related standard, I am just first going to create a chain of thought how you should approach these standards. And we're going to approach these standards in a 3 block. Because if you want to get, because if there is going to be too much of things to remember, there is a certain sequence in which you can create a chain of thought in your mind. So when I'm going to look at these standards, I'm going to study these standards more or less in 3 blocks. So let me tell you what kind of things we're going to study in each block. Let me first of all tell you, if a company incurs an expenditure and it wants to reflect an asset in the balance sheet, there are 2 parameters which you need to meet. One is called definition and one is called recognition criteria. If, for example, you're looking at a PPE, for example, if you're looking at a property, plant, equipment, there is what we call a definition of PPE. So you need to meet the definition, but then apart from the definition, you also need to meet a recognition criteria. The recognition criteria basically focuses on that, can this item of expenditure be recognized in the balance sheet as an asset or not? So you need to meet a definition also, and you need to meet a recognition criteria also. So in the block number 1, what we will do, we will cover the concept of definition and we will cover the concept of the recognition criteria. Every asset related standard, when we're going to study the block number 1, we will concentrate on what is the definition parameters and what is the recognition criteria. Because if you meet the definition, but let's say if you don't meet a recognition criteria, it cannot be reflected as an asset in the balance sheet. And at few places, not many places, but at few places, what I will do, along with the definition and the recognition criteria, it is also important to look at the scope of the standard. Because sometimes what will happen, you will meet a definition, you will meet a recognition criteria, but the scope of the standard says that it is not covered under this standard. Maybe because there is a certain specific standard which is dealing with the agenda. So they will basically give you the inputs that this is the definition met, this is the recognition met, but the standard in the scope says it's not covered under the standard. There is another standard which addresses the issue. So at some places, we will also make a reference to the scope of the standard as well. Then comes the next area of discussion, and that is supposed to be the step number 2. Once you've decided that yes, it can be shown as an asset in the balance sheet of the company, the next focus area is the measurement. What is the value at which it will be shown in the balance sheet of the company? So the first step is, can it be shown as an asset or not? Do you meet a definition and recognition? If it can be shown, what is the value it can be shown? So when you look at the measurement, we'll focus in terms of initial measurement, and we'll also focus in terms of subsequent measurement, that is at each balance sheet date. So we need to decide at each balance sheet date, can it be shown as an asset in the balance sheet or not? And then finally, I will come to block number 3, where we will consider the other aspects of the standard. Like for example, generally when you're considering an asset, there would be a need to consider a depreciation, or let's say there is a need to consider amortization. If it is intangible, then there will be aspects like impairment, etc. I'm not discussing what is impairment at the time being, but when you're going to consider other aspects, we will basically focus that, are we supposed to consider a depreciation? Is there any kind of amortization to be taken or not? And we also need to focus on a very important aspect, and that is impairment. Though there is a separate standard devoted to this, that is IS 36, but we'll also look into the impairment aspect. So your chain of thoughts should be very clear in the mind that in block 1, you need to focus on a definition recognition, if the need be the scope. In block number 2, how do you measure the asset? What is included, excluded in the valuation of that asset? How is the asset represented at the balance sheet date? And then looking at the other aspects, whether a depreciation or whether a amortization is taken or not, and what are the key aspects in terms of impairment? Do we need to impair the asset or not? Basically looking at the application of IS 36. right? I guess so far so good. You're clear with my chain of thought, how we're going to proceed with these standards, right?
Yes, sir.
Wonderful indeed. So this is my chain of thought. I thought I'll just share that inputs to you at the very start. And as we are going to go to a lot of asset related standard, naturally after some point of time, you might have a confusion as well. Okay, this asset was measured at what value? What were the definition parameters? So I'm going to give you a comprehensive chart in between. Once we've covered a lot of standards, I'll give you a comprehensive chart so that in one single chart, you will be able to get a complete inputs as well. Now, having said that, there are a few standards, of course, you've done in financial reporting as well. So naturally, the emphasis of these kind of standards is not very heavy when it comes to SBR, because the frequency of certain standards is more in terms of FR, and if you look at the frequency, the weightage of the standards in SBR changes. So at certain places, like for example, we're starting with IS2. I will not get into too much of in-depth knowledge on IS2. We'll just have a very basic knowledge, because like for example, if you look at the book in terms of Kaplan, for example, you will see in terms of Kaplan, there is a chapter which is devoted, like chapter number 5 is there. Though I'm covering start now right now in chapter number 6, which is inventories and agriculture. So they've just tried to cover in non-current assets a lot of standards, 6, 7 standards in a single go in one particular chapter, just trying to give you a recap of what you've learned in FR. Okay, so let's, I think, begin the journey. So I'm going to start my discussions with reference to IS2, that is inventories. Now, it is very important to conceptually understand the definition, and I'll tell you why. For example, if you look at a past examination question, they gave a question about cryptocurrency. And when they gave a question about cryptocurrency, so, you need to evaluate, is it an intangible asset? Or is it a financial asset? Or is it to be treated as inventory for that matter? So they were very focused on that, does a person understand the parameters of what is an intangible asset? What is the parameters of a financial asset? So you need to be clear on the definition from that grounding point of view. Nobody is going to ask you a direct question in terms of is this inventory or not. But when it comes to questions like, as I said, example like a cryptocurrency. So you need to tell the examiner the broader parameters, that is it meeting the definition parameters of, let's say, an intangible asset. So you need to prove that. So unless you are clear with the definition aspect, you can't answer those indirect kind of questions. So therefore, my emphasis will be on giving you clarity in terms of the definition, not just remembering the definition, but just trying to understand what is the concept bit in terms of definition. Now, before I start with the standard IS2, I have a small little question coming to my mind. You want me to show you the definition first, or you want me to directly ask a question? I'm not explaining anything for the moment. I'm want to ask a question, so you want me to show you a definition and then take up your give you a question, or you want me to directly give you the answer question? You want to have a look at the definition or directly answer?
Let's the definition this thing.
Okay, so let's do one thing. I am going to give you the definition. Just hold on for a second. So I will not explain the definition to you. You need to apply your own thoughts. And based on that, you can decide. I'm just sharing the screen. Let me know if you can see the screen inventories. Okay, great. So you can read the definition of inventories, which is given in the standard. Just read that point ABC, and then based on that, I'll put a question to you. Let me know once you've read, then I'll put my question.
Let's go at this.
Okay, wonderful indeed. So let me put my question to you. I'll just stop sharing the screen. Let me give you the facts of the case, and then I think you can decide. So let me give you the facts of the case. You can decide. Now, let's say there is a restaurant, let's say X Limited. Hear the facts carefully. Let's say there is a restaurant that is X Limited. It is in the business of selling beer. It is in the business of, let's say, selling beer. Now, what happens? The restaurant is selling beer. The consumers consume the beer and they leave the empty bottles in the bar. So they consume the beer and they leave those empty bottles in the bar. Now, what the restaurant does, it takes these empty bottles in its possession. So once the customer leaves these particular bottles in the bar, they take a physical possession of these empty bottles and then they invite tenders. To sell these empty bottles. So the customer leaves these empty bottles and the restaurant takes a possession of these empty bottles and then they invite tenders to sell these empty bottles. Now my question is fairly simple, that as far as these empty bottles are concerned, do we consider them as inventory? Do we call them as inventory or not? So should I bring them under the purview of inventory, or I should say that it is supposed to be a scrap? So do we consider it as inventory or do we consider it as a scrap?
Scrap.
Okay, I'll start getting answers, scrap, scrap, scrap. But in between, I get one answer as well, that it is inventory. And now the trend is churning to inventory. Majority is saying it's a scrap, but in between, we're getting some answers, inventory as well. Wonderful indeed. Okay, so I am, of course, not going to give you the answer immediately like this. And you said in revenue from sale of bottles from part of the major revenues, then bottle will be considered as inventory. Well, I think I've given you the facts, so you decide whether revenue is major or not. Okay, I'm not going to give you an answer right away. I will now work upon the definition, and after working upon the definition, we'll come back to this case study. We will see whether this empty bottle is inventory or scrap based on the definition. So what I'm going to do, I'm going to come back to the definition and I will convert the definition into a simple step-by-step model. Would you like to give it a name? My
Series
video is
model.
hanging. Is it possible to receive the recording of this class? You'll get the recording later. That's right. It's going to be called as Kiwi's three-step model. Thank you. So I'm going to work upon, okay, before I forget also, let me just tell you that I don't know if you got the information or not. Tomorrow, due to some reasons, I'm not taking a class. I don't know if you got the information or not. Forgot to tell you last week as well. So tomorrow, there will be no class. So after this, I'll be meeting you in the next week only. So please remember, there will be no class. And I'll share my number also today. Maybe we can create a WhatsApp group for any kind of doubts and all you have as well. So I'll just share that number also in between a little later. Okay, so let's do one thing. Let's come back on the agenda. And I'm going to come back to the definition and I'm going to create a three-step model. So hear me carefully, don't worry, the notes will be made later. But first, give me a very good listening. It says inventories are assets. I think before I read the clause ABC, what is coming to my mind is that they are saying that inventories are assets. Now, why I'm focusing on the word asset, I have a little funny question to ask you, but I think it is very important to ask you. My question is that every item which is shown in the balance sheet on the asset side, is it supposed to meet a definition of asset? Everything which you show on the asset side of the balance sheet, is it required to meet the definition of asset? You must be thinking, what a weird question I'm asking. I'm asking you that it is shown in the balance sheet as an asset. So is it supposed to meet the definition of the asset? And the answer is no. The answer is no. I'd like to draw your attentions a little advance. Like for example, when we'll go to PPE, IS 16, the standard says that PPE are tangible items. It doesn't say that they are assets. Trust me, in terms of property, plant, equipment, I am nowhere required to prove that it's an asset. You don't need to meet the definition of asset. So one very important element is that if I'm saying that inventory are assets, you need to meet the definition of asset. But when it comes to PPE, it says it's a tangible item. I don't need to prove that it's an asset. So my step number one, I would say my step number one would be to identify, rather I would say the first two steps will be devoted in terms of identifying that is the given item asset or not. So how do I define that a given item is an asset? I would say there are two parameters before you call anything as an asset. Number one, the parameter number one is that you need to prove that there is a control. And the parameter number two is that you will get future economic benefits from that asset. So before you call anything as an asset, you prove that there is a control. How do I prove a control? I would say the control stems out of either a legal ownership. Either you prove that the item in question, you've got a legal ownership. And if not a legal ownership, then you need to prove that you have the right to restrict others. You've got the right to restrict others from use of the asset. You've got the right to restrict others from use of the asset. So if you can prove any one of these parameters, we can say that yes, there is a control. I think let's put a simple question to you. In terms of this empty bottle, when the company is taken it in its possession, I believe, of course, I can't say that bottle you can have a legal ownership. Bottle is something which you can't prove a legal ownership. But will I be able to prove that once the restaurant takes it in its own possession, you get the right to restrict others from using that asset? What do you say? Will I be able to prove the fact that there is a right of restriction? I can restrict others from the use of the asset, correct? And that's right. So in this particular case, I would be able to prove the right to restrict, because once you get the bottles in your own possession, you will get the right to restrict others from the use of the asset. Control is proven. Next, when you look at the next step, that is in terms of future economic benefits. Future economic benefit means that it increases your revenue, or maybe it decreases your cost. Either you're able to save cost or you're able to increase revenue. Either ways, we can say it is economic benefits. The economic benefits could be in terms of increasing revenue or in terms of saving costs. In terms of inventory, you need to basically prove that the revenues will increase. Is the restaurant selling these bottles by inviting tenders? And does this mean that in this particular case, you will be able to increase your revenues as well? I would say yes. So I think considering the right of restriction proves a control, and considering the fact that in this particular case, the revenues will increase because of the sale of these empty bottle, economic benefits will come. And let me also tell you that if you're looking at the economic benefits, the probability of these benefits arising should be more than 50. And can I say that in this particular case, if the company is inviting tenders, I think it definitely indicates, number one, the materiality of benefits coming in. And I think it also indicates the probability of benefits coming in. Why would a company, invite tenders unless they know the material amount is material, and there is a quite a good probability of getting benefits as well. So my step number 1 and 2 will get met. And then I come to the step number 2, where the objective is to prove the purpose of this inventory. And if you look at this clause ABC, which you've seen, I would say the clause ABC is indicating the purpose. And I would say inventories are either in the form of finished goods or in the form of WIP or in the form of raw material. Generally, I'm saying generally, when you're looking at finished goods and WIP, the objective will be a sale in the ordinary course of business. And when you're looking at raw material, the objective will be that they will be consumed in the production process. And in this particular case, let's consider, is this empty bottle held for sale? Yes. Now you would say, sir, it is held for sale, but it should be held for sale in ordinary course of business. So in this particular case, I would say it is ordinary sale of business as well. Even though the company is in the business of selling beer, but then any kind of incidental activities would also be covered in out here. So the company's main objective might be to sell beer, but then as a part of the incidental activities, they're going to send empty bottles as well. So if they're going to sell empty bottles in this particular case, then I think one can definitely say it is in the ordinary course of business. So I would say number one, control, yes. I would say number two, economic benefits probability more than 50, yes. The purpose is sale in the ordinary course of business, yes. Is the definition met? Yes. And interestingly, IS2 has got no definition parameters. No, sorry, recognition parameters. As I said, there is a definition and there is a recognition, but IS2 has got no recognition parameters. If you meet the 3 steps of definition, you can reflect it as an asset in the balance sheet. Did you get my point?
But sir, doesn't ordinary course of business basically mean what the company actually deals in?
Okay. Now, when a company would actually, draft a MOA, Memorandum of Association or Article of Association, it is always mentioned that this is the main business and any incidental activities related thereto would also be a part of your business. Now, if you're in the business of selling beer, then I think bottles is something which will incidentally arise. So I think if you're going to sell those bottles, it's incidental to the main operations. So we can't say that it's not ordinary course of business.
But
Right?
in one way, it's also scrap, right? Because it is what is left after you have sold your main product.
No, no. You see, you can't say, if the company is having a materiality factor in terms of inviting tenders, how would you call it as a scrap? In this particular case, it's more like, I would say, kind of a byproduct, though it's not a very correct term to use. But it's more like a byproduct that you're selling beer and you're also getting those empty bottles. So you're also selling those empty bottles. So whatever is the unsold bottles with you, which are sold by way of tenders, is incidental to your main business. Can you imagine that if you're selling a beer, you are not selling empty bottles as well? I would say generally yes. So that would
Yeah,
be
it's possible
something which is
because they
incidental.
can sell the beer in cups also in those big glasses as well.
See, that is
So
subjective. We
it's
change the
not.
facts of the case, that would be different. But in any case, in this particular case, considering the facts that the company has got a material level of sale with tenders invited, it is incidental to the main business. I don't think so you can really prove that. Though, let me tell you, in IFRS, things are subjective. It is quite possible that two experts may not reach a same conclusion, but they'll still fight out the case. So if you're going to maneuver that facts and all, there is always a scope of judgment. Right. I hope you got your answer on that. Okay,
Yes,
so far
thank you,
so
sir.
good. You're welcome. So far so good. So we can say that in this particular, and this particular example, let me tell you, is one of the cases which has been a case of advisory opinions as well in certain places. So this was based on the facts which I've taken. It's not a self-created example either. So I think the facts of the case were there, and they decided this on the basis of facts of the case. Okay, so we have decided on the block number 1 that when you're looking at inventory, there are 3 steps on the definition. No recognition parameters. You meet the definition, you can show the item as a inventory in the balance sheet of the company. I guess now we can document the steps to you, I guess. So let's, I think, document the notes. We'll put down block number 1. And in terms of block number 1, I'm going to call this as definition. and recognition criteria. So I'm going to call it as definition and recognition criteria. But of course, in this standard, there is no recognition criteria. So we're just going to make a mention out here that there is no recognition criteria. There is no recognition criteria in IS2. So you just need to meet a definition and that would be the answer. So let's see what is the 3-step. I'm going to put it as KB's 3-step model out here. So in terms of the step number 1, the focus is, does the entity have a control? Underline the word control. Does the entity have a control over the item? Okay, can inventory be tangible or intangible, or is it always tangible? Can inventory be intangible in nature?
Yes.
Yes. Like for example, I might be a software dealer. So when I'm looking at the item, it could be tangible in nature or it could be intangible in nature. Doesn't make a difference. So whether it's a software dealer, then it can be intangible. Therefore, I'm using the word item. So does the entity have a control? How would I prove a control? You need to prove a control either, you can say, by way of legal ownership. We can prove a control either by way of legal ownership, or we can prove a control that where we have got right to restrict others, where we've got the right to restrict others from use. So either of the two things have to be proven. Either you prove that you've got a legal ownership or a right to restrict others from use. So when you say that, do you control the item? The answer would be a yes or the answer would be a no. So if your answer is a no, then I would say standard is not applicable. And if the answer is a yes, I'll go to the step number 2. All right, let me know if you're done. I'll take it further. So basically, step number 1 is a part of the larger definition that you need to prove it to be an asset. Control is one of the parameters of asset. Right, let me know once you're done. I'll take it further. Right, done. Can I take it further?
Just a minute, sir.
Okay, let's go to the next one. Then we go to step number 2. Now, in terms of the step number 2, which is again a part of the asset definition, we need to see, will future economic benefits, I'm putting it as FEB, future economic benefits are probable. So when I say future economic benefits are probable, probable means the probability of benefit is more than 50. So when we're looking at the future economic benefits, the future economic benefits could again be either in the form of increase in revenue. So either your revenue goes up, or you can prove it that it will lead to saving of expenses. So either we prove that the revenue pushes up or we can get saving of expenses, then we can say it is probable. So here again, the answer would be a yes or a no. So if we say a no, in that case, again, standard is not applicable. And if you say a yes, we're going to go to step number 3. So this is again a part of the asset definition itself. And then we go to the step number 3. And in terms of the step number 3, we need to look at the purpose. And in terms of the purpose, depending upon whether it is finished goods or WIP, the purpose would be sale in ordinary course of business. The purpose will basically be a sale in ordinary course of business. And if it is a case of a raw material, then in that particular case, the purpose will be consumption. The purpose in this particular case will be consumption. So the purpose will vary according to the nature of the item. If it is FG or WIP, the purpose is sale, and if it is raw material, then it is consumption. Right, so I think my block number 1 is done. Definition, 3 parameters taken care, recognition criteria does not exist. So far, so good. Let me know if you're done. We'll go to the block 2. Right, can I take it further, I guess? Done?
Yeah.
Okay. Now we go to the block number 2, which is on the measurement aspects. So the next area of discussion is the measurement aspect. And when I'm looking at the measurement aspect, I would say there are two things. How do you measure the inventory initially, and how do you measure it on a subsequent basis? So I am going to come to a small little chart out here that when you're looking at a measurement, are we looking at initial measurement or are we looking at a subsequent measurement as well? Now, one thing is very clear, that if you're looking at initial measurement, then it is always taken at a cost, and this cost means we're looking at historical cost. Now, when you say that it is taken at cost, we need to be very clear in the mind that what is included in the cost and what is excluded in the cost, but I think we'll discuss that later. So I'll give you a list in terms of what is included and what is excluded, though we may not get much questions on this area at all because this is more focused on FR. So we will take care of this list. I'll give it to you later, very soon, of course, today only. But I'll give you a list of what is included and excluded later. So we have mathematical computations that this is taken and this is not taken. Now, when it comes to a subsequent measurement, in this particular case, we can say the subsequent measurement is to be seen for FG separately, WIP separately, and raw material separately. When it was initial measurement, we just said cost irrespective of the category. But when it comes to subsequent measurement, the focus is, are we looking at finished goods? Are we looking at WIP, or are we looking in terms of raw material? Now, let me make it once very clear. If you're looking at the finished goods, the standard says it is taken at cost or net realizable value, whichever is less. Even if you're looking at a WIP, the measurement is same. It is cost or net realizable value, whichever is less. But when it comes to raw material, the raw material valuation depends upon FG. It depends upon the finished goods valuation. So we need to be very clear that raw material is not something which is sold. Raw material is something which is consumed. So since it is consumed, its valuation depends upon the finished goods. So in this particular case, when you look at the valuation of the raw material, we can say if your finished goods is measured at cost, the standard says that if your finished goods is taken at cost, the raw material is also going to be taken at cost. Your FG is at cost, then raw material is also at cost. And if the FG is taken at net realizable value, then the raw material is taken at, remember, cost or replacement cost, whichever is less. You cannot get a NRV for raw material because raw material is not sold. So in this particular case, when you say replacement cost, what does a replacement cost means? If you were to buy raw material in the market today, what is the price at which you can buy it? That's called a replacement cost. So if your FG is taken at NRV, raw material will be taken at cost, or we say replacement cost, whichever is less. I put it as RC. So we need to be very careful that raw material valuation is dependent upon the finished goods valuation. If the company measures its finished goods at a cost, then raw material is also at cost. I don't care about the replacement cost in that case. And if the FG is taken at NRV, raw material will be cost or replacement cost, the price which you will pay to buy new raw material, whichever is less. Right? This is the parameters which are given in the standard. I'm not getting into details in terms of logics, etc. That I think your prior knowledge on FR will be good. I'll not come to the point, why does the standard say all these things? That is something, which is based on prior knowledge. We've got numerous other things in SBR. So I'll not get into details of why does the standard say all these things. That is all based on your prior knowledge. Okay. So
Sorry,
now
sir,
the
but
question. Yes.
the subsequent valuation of the inventory, does it mean at the end of year and initial means at the beginning of the year?
Yes,
So,
initial would mean when it is purchased or it is manufactured, and subsequent means balance sheet date, every balance sheet date.
got it. Okay.
Yeah. Okay, now I think my focus point is number one, to understand what is this NRV. So I think let's do one thing. Let's focus on the net realizable value. We'll come to this inclusion, exclusion later, but let's focus on this net realizable value. The standard says that NRV is supposed to be what we call estimated selling price minus estimated cost of completion minus estimated cost of completion and minus estimated cost minus estimated cost necessary to make sale. Estimated cost necessary to make a sale. So this is the definition of NRV which is given in the standard. So it says it is estimated selling price minus estimated cost of completion minus estimated cost necessary to make sale. Now, one thing which I like to clarify at this end. When you're calculating the NRV, please be careful because many people tend to get confused on that. If you're calculating the NRV for FG, you will take this. But this is not concerned with FG because FG is already complete. So I don't need to consider the cost of completion, but I will definitely consider the estimated cost necessary to make sale. But when you're calculating the NRV for WIP, you're going to consider this. You're also going to consider the cost of completion, and you're also going to consider the cost necessary to make sale. So in other words, if somebody were to ask me that please give me a separate definition of NRV for a FG and for a WIP, I'll say, okay, if you want for FG, you take the estimated selling price of the finished goods. And from that, you reduce only the estimated cost necessary to make sale. But if you're wanting a NRV of WIP, I will say, okay, let's take estimated selling price of FG, mind you, not WIP. I'll take the estimated selling price of FG minus the estimated cost necessary, the cost of completion, and also the cost to make sale. I'm just interested in taking a small little test at this stage just to see that whether you're clear with the concept or not. So very simple little case. Let me just, I think, test your knowledge on that. Let's say this is finished goods and let's say this is WIP. So let's say the cost of the finished goods is, let's say 120, and the net realizable value is, let's say 150. So this is basically, you can say, selling price minus the cost necessary to make sale. Now my question is very simple. Let's say this is 70. Can you tell me what is the NRV of WIP? Calculate what is the NRV of WIP in this case. Let's see how do you apply the funda. I'm waiting for your inputs on the NRV calculations. $40 can't be 40. 130. I don't think so. 87.5. Oh my God. Where do you get that? Maybe I could also request people to please put their cameras on. Everybody's too apprehensive of putting their cameras on. Your learning experiences will definitely get enhanced, trust me, if you're putting your cameras on. Otherwise, it's a choice. Of course, I can't force you. I got 3 answers, and all 3 answers, unfortunately, is not correct. I knew this, that's why I asked this question. Every time we ask people to calculate NRV, there is some kind of confusions in NRV. Okay, finally, I got the answer 80. That is correct. Good. 80? No. Sorry. I'm afraid no. Oh my God. Let me, I think, now give you some logic also for this. Please watch this carefully. Please watch this very carefully. Can you tell me what is the estimated cost of completion? If the cost of WIP is 70 and the cost of FG is 120, what does the difference of 50 represent? Is it the estimated cost of completion? Of course. I'm done. What is my estimated selling price? 180. What is my estimated cost of completion? 50. What is my cost necessary to make sale? Did you get the answer? My NRV is supposed to be 100. Now, I want you to see another logic as well. I've taken the estimated selling price of FG minus the cost of completion and minus the cost necessary to make the sale to get the NRV. Now, let's see something interesting. Just watch this. Why are they telling you to reduce this? Please watch the maths carefully. If you look at the finished goods, the cost is 120 and the NRV is supposed to be 150. If you look at the WIP, the cost is 70. Now, watch this very carefully. If this clicks, it clicks in a second. Otherwise, I don't know. Can I say, is that 70 and 150 comparable? Of course not. This is a cost of incomplete item and this is NRV of complete item, so they're not comparable. Let me ask you mathematically. If I add 50, is it comparable? If I add 50, is it comparable to 150? Yes. Alternatively, if I reduce 50, then also it is comparable. Get this very clear. See the mathematical logic. In this case, if you add 50, you get the cost of complete item, NRV of complete item. Now, instead of adding 50 to the cost, why don't I reduce 50 to NRV? Mathematically, it is same. Did you get the logic of why this estimated cost of completion is getting reduced for a WIP? Because when you're considering FG, you are comparing a cost of complete versus NRV of complete. But when you've got WIP, it is a cost of incomplete versus NRV of complete, not comparable. To make them comparable, either add the cost or reduce the estimated cost from NRV. Did it make sense? Did you get the logic? Great. So in this particular case, that is the reason we take estimated selling price minus the estimated cost of completion minus the cost necessary to make sale. So if I come back on the agenda, so I can say now my mind is working very clear. Let me shoot some questions to you and you can vouch me. Can I say the valuation principle of FG and WIP is same, but is the NRV definition same for FG WIP or different? When I'm looking at the cost and NRV, the measurement principle is same, but is the NRV definition common or different? That's right, it's different. It is different. When you're looking at the NRV of finished goods, the NRV of the finished goods is taking selling price minus cost to make sale. But when you're looking at WIP, it is selling price minus cost of completion minus the cost necessary to make sale. And raw material, of course, depends upon the FG. FG at cost, raw material at cost. FG at NRV, raw material at cost or replacement cost, whichever is less. Okay, now another small little inputs which I would like to make at this stage. When you are calculating the NRV and you are considering the estimated selling price, there is a small little clarification which is given in the standard. It says sometimes you may be producing inventory against specific contracts. So in this particular case, when you calculate the NRV, don't take the journal price appear in the market. Consider the contract price. So if the company has got inventory produced against customer order, specific customer order, then instead of taking this estimated price, you will take a contract price. So we are going to take a contract price if there is inventory against specific order. So if there is any specific order, then you've already predetermined the contract price. Then instead of taking a general price in the market, you're going to consider a contract price for the purpose of calculating the NRV. Okay. So what is the next agenda now? I now need to basically give you this part. That when you consider the inventory, we need to understand what is included and what is excluded. So that I'm going to give you a simple chart which will give you the inputs in terms of what is included and what is excluded. So let's give you now a chart that when you're looking at inventory and you're saying that it is taken at cost, so we need a list of items, what is included in cost and what is excluded in cost. So there are two things what we need to understand, that when you consider the inventory, what is included and what is excluded. Now, this is just a reminder of what you've done in terms of FR. So I'm just reminding you that in terms of inclusion, there are three kinds of cost. The standard says when you consider the inventory, there are three kind of costs to be taken. One is called cost of purchase, one is called a conversion cost, and one is called other cost. So there are three broad costs. One is called a cost of purchase. One is called a cost of purchase. One is called a conversion cost. And the other one is called other costs. So these are the three costs which are taken for the purpose of inventory valuation. So we need to consider a cost of purchase, a conversion cost, and other cost. Small little question at this stage. Is depreciation included in inventory? Is depreciation a part of the inventory valuation?
No.
I don't know why people always say a no. I'm getting answers no, no, no. Oh my God. Why not? You hear depreciation, which is a non-cash expenditure, and you suddenly feel it's not part of inventory. Depreciation is a part of production overheads. And it is very much a part of inventory valuation. Just because it is non-cash doesn't mean it's not taken. It is. It is taken. Okay, so let's see what is taken as a part of the cost of purchase. So when you consider the cost of purchase, number one, you need to consider a purchase price. And when you consider the purchase price, this is going to be taken net of trade discount. This is going to be taken net of trade discount, not cash discount. So when you're going to consider the cost of purchase, you will take a purchase price which is supposed to be net of trade discount, not cash discount. Then the standard says as a part of the purchase cost, you will take any duties and taxes. You will take any duties and taxes which are not subsequently recoverable, which are not subsequently recoverable, which are not subsequently recoverable from taxing authorities, which are not subsequently recoverable from taxing authorities. For example, let's say you paid a GST, like in India, you paid a GST and you will get a GST input credit. So that means it is recoverable from the government. Are you going to include it in inventory if you get an input credit? The word is not recoverable. So you're going to add those duties and taxes which are not recoverable. So if there is any GST input credit, are you going to consider that as a part of inventory? You are getting an input credit. That's right. No. But in a situation you're not getting an input credit, would you consider GST as a part of inventory? Yes. So if I pay duties and taxes for which input credit is available, not taken. Input credit is not available, taken. So we'll take those taxes for which input credits are not there. And apart from this, we will also consider, you can say something like loading, unloading charges. You're buying the inventory and then you have to incur some loading, unloading charges. All that would also be considered as directly attributable, unavoidable expense in nature. Then comes the other category of cost, and that is called conversion cost. Conversion cost will basically include two costs. One is called direct labor, and the other one is what is called production, or what is called factory overheads. So the second kind of cost which is taken is called a production or a factory overheads. And trust me, depreciation is a part of this factory overheads. When you consider your factory overheads, depreciation is a part of the factory overheads, and you need to consider both variable as well as fixed overheads into account. Variable and fixed overheads both will be a part of this production overheads. I think let's ask you a question. When you consider your factory overheads, you need a recovery rate, right? You need to basically translate your factory overheads on a recovery rate. Can you remind me, how do you calculate a recovery rate? For a fixed overheads, can you remind me that if you want to calculate a recovery rate for fixed overheads for inventory, how do you calculate a recovery rate for fixed overheads? We consider a recovery rate, convert it on a per unit basis. So what is the manner in which a recovery rate is taken for the purposes of fixed overheads? Fixed cost divided by units, but which units? That is correct. You need the fixed cost per unit, you will divide it by units. But which units will you divide it by to calculate a recovery rate?
Finished goods,
No, but which production? Normal, actual, which production?
actual,
You divide it by actual. No.
Estimated.
Budgeted.
Budgeted, not always. Oh, so should I give you logic or the formula? I think formula is better. Oh, what do you say?
Logic.
Okay, let's, I think, give you that. We are doing basic stuff, baby stuff, which is not too relevant for SBR. So I'm not, wanting to spend too much time on these parts. But still, let's I think work on this. Now, I am looking at the concept of a recovery rate. Now, watch this carefully. I'm going to give you a very interesting logic which is there in terms of IS2. Now, let's first appreciate why do we need a recovery rate. When you calculate the inventory valuation, I would say inventory valuation has got both variable cost and a fixed cost to be included. Inventory will include the variable cost also and the fixed cost also. Now, the variable cost is always expressed on a per unit basis, but the fixed cost is always expressed as a total. So the problem is that if you need inventory valuation, you need to translate this fixed cost, which is expressed as a total, on a per unit basis. Hear me carefully, get the logics clear. The variable cost is expressed on a per unit basis and the fixed cost is expressed as a totality. And in order to measure the inventory, you need to translate the fixed cost on a per unit basis. Now, how would you do that? So earlier, the thought process of the standard setters was that, what you do in, what you do in management accounting. What you do in management accounting is that if you want to calculate a recovery rate, you can take your fixed overheads and you need to divide it by what is called normal or what we call the budgeted production. So they decided that we're going to apply the same concept as management accounting, that if you need a recovery rate, you just divide your overheads by a normal level of production, get a recovery rate. So now with this inputs, let's do one thing. Let's visualize a profit and loss account under three situations. Let's visualize a profit and loss account in three situations. I'm looking at a profit and loss account and I'm looking at three situations in this case. Watch this carefully. So I'm making a T-shaped P&L and I want to look at three different situations in this case. Let's assume some figures and then proceed. Let's consider my fixed overheads is to the extent of, let's say, 10 lakh. And the normal production, let's say, is to the extent of 2 lakh. So we can say the recovery rate is supposed to be 5 rupees per unit. So I divided my fixed overheads by a normal production level and we said that the fixed overhead to be taken in inventory is 5 rupees per unit. Now, when the company incurred the fixed overheads, they recorded the expenditure of 10 lakh rupees as an expense. Now, let's assume that the entire production is unsold. Let's assume as an extreme, let's say the entire production is unsold and let's assume that your actual production, let's assume that the actual production is equal to 2 lakh units itself and the entire inventory is unsold. Can you tell me how much overheads per unit will be included in the closing stock? How much inventory, how much fixed overheads will be included on a per unit in the closing stock?
5.
That's right. We'll take 5 rupees per unit. So this works out at 10 lakh. So can I say the entire 10 lakh enters into the valuation of the finished goods? Perfect. You incur 10 lakh rupees. And since the entire inventory is unsold, the entire 10 lakhs is a part of inventory, resulting in no profit, no loss situation. Let's go to the second situation now. Let's have a look at a second situation. You recorded your fixed overheads, let's say 10 lakhs. Let's say the entire stock is unsold, but this time I'm interested to take the actual production not at 2 lakhs, but I'm interested to take the actual production as 1.8 lakhs. So in this case, I'm considering that my actual production is 1.8 lakh. So you include 5 rupees per unit in the closing stock. So this works out at 9 lakhs. Correct. Now out of this 10 lakh, only 9 lakh is got included in the inventory. So what is the remaining 1 lakh? Is it an under recovery? Can I technically say that this is what is incurred and this is what is recovered on the basis of recovery rate? So are we saying that 1 lakh rupees is an under recovery? Am I right?
Yes.
Correct. As per the management accounting, this becomes an under recovery and this under recovery indirectly will become a part of the loss of the company. I think you can definitely guess what I'm going to do in the third situation. Any guess?
Over recovery.
Yes. In the first case, I took the actual and normal production equals. Second, I took actual below normal. Third, I'm going to take more than normal. So let's say there is a fixed overheads of 10 lakh rupee and everything produced is unsold. So let's consider in this case, the actual production is, let's say, 2.5 lakhs. So I would take 5 rupees per unit as a part of my closing stock valuation, and this works out at 12.5 lakhs. So out of 10 lakhs, 12.5 is getting included in the stock valuation. So can you repeat why 5 as per unit? Well, your recovery rate is still 5. I've not changed my recovery rate. So recovery rate in all situations would remain 5. So we are getting a difference of 2.5 lakhs, and I'm sure you agree that this is nothing but over recovery. But you know what I want to say at this stage? Vouch me for this. Are you saying that this under recovery means a loss for the company? And are you saying that this over recovery becomes a profit for the company? Are you saying that you're going to get a loss without sale? Are you saying you're going to get a profit without sale? Am I right? Is this technically correct to interpret that this is a loss without a sale and this is a profit without a sale? The under over recovery is nothing but gain or loss without a sale of inventory. Is that right to say? That's my question. Is this under recovery like a loss without sale? Is this over recovery like a profit without sale? You said no, it is. It is. What is under over recovery? It is nothing but a profit or loss. The company is recording 10 lakhs on the fixed overheads and only 9 lakh is getting included in inventory. So if you calculate a balancing figure, your loss will be appearing at 1 lakh rupee. And in this particular case, if you calculate a balancing figure, you are getting a profit. This under recovery will become a loss for the company. They'll get a loss without sale. The over recovery would mean that they are going to get a profit without sale. So standard setters started thinking that one of the most dangerous situation is this. If the company knows that recovery rate is based on a normal production, I think anybody having reasonable minds will say, let me always prove that actual production is more than normal production. Am I making sense? Anybody would start manipulating that if I know that I can get a profit without sale, let me say that my normal production is 2 lakh and my actual is more than 2 lakh. Every time let me get over recovery. Let me get a profit on sale. The standard setters became very apprehensive of this and they said, we amend. And they said, we amend. And they said that instead of taking normal production, you will take normal or actual production, whichever is greater. They amended the formula. They amended the formula. They said, it's a very risky situation. Over recovery means a company will book a profit without a sale. No, we don't want that. So they said, let's amend the formula and let's consider that to calculate a per unit rate, you will divide fixed overheads by actual or normal, whichever is greater. Now let's put the questions back to you. Let's look at the first situation. Do you need to change the recovery rate or does it continue with the same? Actual normal production is same. It is same. In the second case, do you need to change the recovery rate or it remains the same? Normal, actual, whichever is greater. So will the recovery rate change or remain the same?
Change.
2 lakh or 1.5 lakh, 1.8 lakh, whichever is greater. It remains same. In the third case, will the recovery rate remain the same or will it change? Actual or normal, whichever is greater.
It will be 2.5 now.
Yes. So I will change the recovery rate. I'll divide 10 lakhs by 2.5. So your recovery rate changes to 4.
4.
When this changes to 4, it becomes 10 lakh. And then this over recovery disappears. Which means in IS2, can it ever lead to over recovery? Say yes or no. As per IS2, if you're going to use the recovery rate based on actual normal, whichever is greater, can you ever get a over recovery?
No, sir.
Never. But then the question rises that is this getting under recovery logical? A company is getting a loss without sale. I'll say, okay, you should get a loss. If you operate below normal level of production, whose problem is this? The company's problem. If your actual production is below normal levels of output, you are an inefficient company. And if you're an inefficient company, let you get it under recovery. Let's book a loss. I don't care. So the standard set is very clear that the only possibility is that you can get an under recovery. You will never get a profit without sale, but you will get a loss without sale. If the company operates below the normal productions, it is their inefficiency. Let them book a loss. So therefore, this formula was accepted as a recovery rate. Many people tell me that a recovery rate in IS2 is based on absorption costing. No, it's not based on absorption costing as such. Absorption costing would consider a recovery rate based on normal production always, resulting in under over recovery. But in IS2, the recovery rate is being modified in such a way that it can lead to under recovery, but it can never lead to over recovery. Did you get my point? I want to know something. Did you knew these things earlier or not? Just a little curious to know this. Did you knew these things on why the recovery rate is based on actual normal, whichever is greater?
No, sir.
Okay, great. So in this particular case, we've decided that when you take a recovery rate, you will take the fixed overheads in this case, and you will divide it by normal or actual production, whichever is greater. Normal or actual production, whichever is greater. This is how the recovery rate will be computed. Okay, so this is on the cost of purchase, on the conversion cost. Now comes the other cost. In terms of the other cost, the standard says any cost which is necessary. So that you bring the inventory to its location and condition. They say that any cost which is necessary. See that there is an unavoidable cost to bring it to the condition and location of sale. There are two words which are used. One is called condition and one is called location of sale. So the standard says that when you're considering other costs, see all those unavoidable costs which you will incur to bring it in the condition or the location of sale. What is the condition of sale? It brings into a saleable condition. For example,
Packaging.
yes, for example, a customer tells me that I want a specific design. I want you to make me a tailor-made specific design. So if I incur a designing cost, is it a cost necessary to bring it to the condition of sale? Yes. And location means from where you will dispatch the goods. Like for example, I may have a factory outskirts of my city, but I need to bring those goods to the place from where I will dispatch the goods. So any transportation cost I will incur to bring it at the godown from where I will dispatch goods to the consumer, that's a location. So any cost which you incur to bring it to the place from where I dispatch, any cost incurred to bring them into a saleable condition, that will all be taken. Designing cost incurred, transportation cost incurred, all enters out here. And finally, we've got a list of all the costs which is excluded, with the standard says very clearly that these are not taken in inventory. So let's give you a list of all those costs which are not taken. Like for example, they say you cannot take administration overheads. Office overhead has got nothing to do with inventory production. Then they say you cannot take selling and distribution overheads. Then they also make a mention that in this particular case, you cannot take any storage cost. But there is a little exception to the storage cost. If you've already manufactured the inventory, the storage cost is a no. But if the storage is a necessary part of the production process, then yes. Like for example, a company manufactures wine. This is a real situation. When a company manufactures wine, it is to be stored in containers for fermentation. It's a part of the production process. The storage of the inventory is a part of the production process. So it will be included if it is a part of the production process. So if it is a part of production process, like as I said in manufacturing of wine, storage of the wine is a necessary part of the production process, then it is included. But after manufacturing it, you store it, it's not taken. So if you're going to manufacture the inventory and it is already manufactured and then you're incurring a storage cost, not taken. But it is a part of the production process, then it is taken. And then they said that if there is any kind of abnormal, if there is any kind of abnormal wastages, do not take that into inventory. Abnormal wastage is not taken as a part of inventory. And another important inputs at this stage, what about interest incurred? Let's say if you have taken some loan to buy a raw material for manufacture of inventory, would I be able to include interest? Depends upon IAS 23. Depends upon whether the inventory is a qualifying asset. So I think that part we'll discuss when we come to the case of IAS 23. So I've intentionally not put it across out here. So interest, whether it is a part of inventory, depends upon 23. So I'll just make a little mention at this stage that if you're looking at the concept of borrowing cost, we will see the inputs in terms of IAS 23. We'll refer IAS 23 to understand whether the interest, the borrowing cost is taken or not. We'll see that later. Okay, so this is the inputs in terms of inventory. That's all what is there in the standard. Block number 3 doesn't exist. Inventories are not depreciated. Inventories are not impairment tested. So the block number 3 for this standard is irrelevant. Our focus is definition, now recognition criteria. Then the focus is measurement. We know cost included, excluded, and we know the subsequent measurement. Block 3 is irrelevant for this standard. No depreciation concepts, no impairment concepts, nothing. Shall we do a small little question which I can see in the book in Kaplan? If you've got the book in front of you, maybe I could just do a small question. There is only one illustration which is given in Kaplan's study text. So would you like me to do that?
Yeah.
Okay, I'll probably share it on the screen also if possible. Just give me a second. Okay, I'll just share on the screen a small little question to you. Let's try this out. Right, I guess you can see the question, right? Okay, don't look at the answer. I'm just going to read the facts to you. And where the need is, I'm just going to lay a little stress on this as well. It says entity has got the following items of inventory. The first one is raw material. Can you remind me what was the measurement base for raw material?
Based on finished goods.
Yes, and if the FG is at cost, the raw material is at cost. If the FG is at NRV, then it is cost or replacement cost, whichever is less. It says raw material costing 12,000 is bought for processing and assembly for a profitable order. Since buying these items, the cost price of the raw material is fallen down to 10,000. Can you tell me finished goods is valued at what price?
No.
But then without that, I can't measure raw material. Let me read the sentence again. Raw material costing 12,000 is bought for processing and assembly for a profitable special order. Profitable special order. What is going at the back of your mind? If you bought this material for a profitable order, does this mean the finished goods is sold at a profit?
Yes, sir.
Yes.
Does this mean the finished goods NRV is greater than cost?
Yes.
Correct? So now let me ask you, when it says raw material is bought for processing and assembling a profitable order, what does this mean? FG is valued at what?
NRV.
Huh?
NR.
If it is a profitable order, the NRV will be greater or the NR will be less than cost?
Greater.
Oh,
So
yeah,
you
that's
measure
it's
the
gonna be
finished goods at
cost.
what? Cost
Yeah,
or NRV?
cost.
Correct. If it is a profitable order, that means the NRV of FG is greater as compared to cost. So finished goods would have been taken at cost. So raw material will be taken at what then?
Cost.
Right. 10,000 is the replacement cost, but I'm not concerned because FG is valued at cost. I hope you got the point A right.
Yeah.
Let's go to the next one now, point number B. It says equipment constructed for a customer at an agreed price of 18,000. Is this the contract price?
Yes.
Then he says this has recently been completed. Is this FG or WIP?
FG.
Correct. When it says it has recently been completed, that means it is FG. So can I say what is the contract price as of now? 18,000. What is the cost? 16,800. It is now discovered that in order to meet certain regulations, there is a conversion cost extra 4,200 to be incurred. The customer accepted the responsibility and agreed to meet half the cost, which means half will be borne by the company and half will be borne by the customer. Would you like to tell me what is the NRV? Indirectly, what is the 2,100? Is it a cost of completion?
Yes.
My God. If it is a finished goods, how can it be a cost of completion? I very clearly asked you that is this FG? You said yes, it is an FG. So is that 4,200 a cost of conversion or cost necessary to make sale?
Necessary to make.
I hope my point is very clear. So which means in this particular case, what is the NRV? Is it, I guess, 18,000 minus half of 4,200, correct?
2,100.
Yes, so we can say the NRV in this case is 15,900 and the cost is 16,800. So you will value it at whichever is less, correct? So 15,900 is a valuation. A brilliant question indeed. It is testing your understanding about NRV. It is testing your understanding about raw material, that if it depends upon FG, how do you locate FG is taken at cost or is it NRV, profitable order. Wonderful indeed. They've given just one illustration, but that's one of the best chosen illustrations to get the funda clear. Correct. Okay, so this is the only illustration which is there, and we are done with IS2. IS2 is done. That's all what is there in the standard. I don't think so. It's too important a standard from the examination point of view. Okay, now we are ready to start with another standard with you. You want me to give you a break first and then start with another standard, fresh mind?
Yes, please.
Okay. So I think we'll take a quick break and then I'll start the journey in terms of IS 16. In terms of IS 16, there is something interesting. I'll tell you later. So let's take a break, 10-12 minutes. Then I'll join you in 10-12 minutes. I need to charge the batteries also, so I'll take a little time maybe so that at least it functions for another hour or so. So please enjoy a break. I'm going to join you after the break. Welcome back, friends. I guess we can start. Okay, I'm getting a question. So in the last class, you had said to study the restructuring. I have a doubt regarding the training at other factories if we include it in measurement. No, it's not. Any kind of training cost or any kind of relocation expenses, they are not taken because they're not considered as directly related to restructuring, so would not be taken. Is there a WhatsApp group for SBR? Okay, I'm just sharing my number and I'll create a group for this where you can ask your doubts as well. But in Zell study text, it is included. I don't know if you look at the standard itself, very clearly mentions training and relocation cost is not taken. So I've shared my number. You can just send me. I'll just create a WhatsApp group where we'll add somebody from the Zell team also. And so do you know, you can, if you want, you can ask your doubts and all concerns in this group. So I've just shared my number. You just send me. I'll send you a link to join that. Okay, now I think let's take the journey forward. I am now coming to the next area of discussion, and that is IS 16. The name of the standard is called Property, Plant and Equipment. The name of the standard is called Property, Plant and Equipment. You know, whenever I look at the name of the standard, the very first question what comes to my mind is that, is this a single word or is this two words or is this three words? What do you say? Is it one word? Is it two or is it three? The word is property, comma, plant and equipment. So what do you say? Is it a single word? Is it two word or is it three words in this? Okay, I got the answer. It is three. It is one. Majority is saying it's one. Somebody said three as well. Majority is saying it's a single word. Oh my God. Let me tell you that there are three words. The word property is different, the word plant is different, and the word equipment is different. These are three different words. Let me first expose you to a very important input. I'm just coming out of this and I'm just using a term which is given in IS 41. It is called biological assets. I'm just coming out of the standard and I'm coming to a term which is used in IS 41. It is called biological asset. The word biological asset is defined as a living animal or plant. So if I look at the definition of biological assets, it says it is supposed to be a living animal. It is supposed to be a living animal, or we can say it is a living plant. And if we look at the concept further, when you say living animal or living plant, it can be further segregated in terms of one is called bearer and one is called consumable. So whether it's an animal or whether it's a plant, it is segregated in terms of two elements. It can be either a case of a bearer animal, or you can say it's a consumable animal. And similarly, in terms of the plant as well, there are two kinds of plant. One is called a bearer plant and one is called a consumable plant. So I guess if you look at the segregation of a biological asset, we can say there are four categories. One is a bearer or consumable animal, and one is a bearer or a consumable plant. Now, the question rises, what is bearer and what is consumable? So let's put it like this very simply to you. Well, I would say if you're going to sell or if you're going to consume, if you're going to sell or you're going to consume only the agriculture produce, if you're going to sell or you can consume only the agriculture produce of biological assets. So we can say if this condition is met, it is going to be called as bearer in nature. The criteria is very simple. So if you say that I will only sell or consume only the agriculture produce of the animal or plant, I'm not going to touch the animal or plant. I will only sell the produce. I'll only consume the produce of the animal plant, but I'm not going to touch the animal plant, then it is bearer. But if you're going to consume the animal plant itself, or maybe you've got a dual objective, it is bearer, it is consumable. So what is important is for a bearer, don't touch the animal plant. Only sell or consume the produce of that animal plant. If you're going to sell, consume the plant animal itself, it is consumable. If you've got a dual objective of selling, consuming the produce and the animal plant, it is consumable in nature. Let's take example and you decide, is it consumable or is it bearer in nature? Let's consider I am looking at, let's say, a chicken where I will sell only the eggs of the chicken. Bearer, consumable.
Bearer.
Correct. Let's say, for example, I am looking at a cow. I'm only going to sell the milk of the cow.
Bearer.
Wonderful indeed. Let's say, for example, I am looking at a mango tree where I am going to sell the mangoes and also the wood of the tree.
Consumable.
Correct. Let's say, for example, I've got a teak tree which I am going to use as furniture.
Consumable.
Teak tree, yes, it's furniture item, it is consumable. Let's say, for example, I've got a chicken, I'm going to sell its egg and also its meat later.
Consumable.
Wonderful indeed. So I think we are pretty clear that what is bearer or what is consumable. Now let me give you some inputs at this stage. When you look at an animal, animals are all covered under IS 41, whether it is bearer or consumable. Plants which are bearer in nature are covered under IS 16 and consumable are covered under 41. So I think I'd like to draw your attention on this particular plant. Is this the plant, the bearer plant we are referring to? What do you say? When we say that bearer
No, sir.
plants are covered under IS 16, yes, it is that bearer plant. It is. You know, when you're looking at this plant, we are making a reference to the bearer plant. So when I say that it is property, the word property means that you're focusing on a building. When you're looking at equipment, the focus is in terms of machinery. And when you're looking in terms of this plant, the focus is on the bearer plant. So I would say that these are three words. When I look at property, plant, equipment, you're looking in terms of property, which is supposed to be a building. You're looking at equipment, which is machinery. You're looking at a plant. Of course, many people call plant and equipment, that's like plant and machinery. But this plant technically is also including a bearer plant. So when I say PPE, technically it's property, plant, and equipment. I hope I am clear with the funda, right? So isn't that plant for the factory things? Well, generally people do call plant and equipment, but technically speaking, this plant is referring to bearer plant, right? Okay, so this was one introduction which I wanted to give you. Now, coming to the point, as I said, every asset related standard we're going to cover in three parts, in three blocks. So my focus number one is on the definition and recognition. And then my focus number two is going to be on the measurement aspects. And then my focus number three will be on the depreciations and the impairment aspects as well. So let's do one thing. Let's first begin with the definition and recognition. But I guess before I speak in terms of definition recognition, I am again interested in giving you a small case study. You want to look at the definition and then answer, or you want to directly answer, your choice. So you want to directly answer the block number one definition, or you want to have a look at the definition first? Any inputs on that? Everybody is majorly silent. I always see that people have to keep looking at the chat if somebody is answering that. Okay. So let me, I think, share the screen to you. Just give me a second. And I'll show you the definition and then you can decide the inputs on that. So let me just share the definition of 16 to you. Okay, I'm going to just share the screen and have a look at the definition. I guess the definition is visible, right? Have a look at the definition of property, plant, equipment. Based on that, I'll give you a small inputs. You decide, is it meeting the definition or not? Just the clause A and the clause B. Let me know once you're read, then I'll just put across the question to you. Ready? Can I put the question to you? Okay, I guess we're ready. So I'm just going to stop sharing the screen and let's put the question to you. I'll give you a practical example of a very interesting case. If you look at, for example, Tata's in Jamshedpur have got a factory. And what they've done, they've constructed a road on outside the factory on government lands. So what Tata's have done in Jamshedpur, it's a practical input. They have actually constructed roads on government lands. Can Tata's reflect the expenditure on that road as a PPE in their balance sheet?
Yes.
Great. So let's get more opinions on that. What do you say? Can I reflect that expenditure as an asset in the balance sheet of the company? I'm getting a couple of yes on that. That's great indeed. Okay, so I think yes makes sense. So I am still going to look at the definition once again, and I'm going to convert this definition into a step-by-step model. Guess how many steps?
Three. Three.
And we're going to call it as what?
KB three-step model.
Right. So you must be thinking every standard three-step model, how many three-step model we're going to get? Unlimited. So we are going to look at another three-step model. I gave you in IS 10 a three-step model. I gave you in IS 37 a three-step model. I gave you in IS 2 a three-step model. Now in IS 16 another three-step model. Let me share the inputs again. I'm sharing the screen and I'll explain. No worry, notes will be given later. Let's first have a look at the definition once again. It says PPE, a tangible item. If you remember when I was looking at the definition of inventory, it said that they are assets. And at that time only I said, if you look at the definition of PPE, it nowhere makes a mention that they are asset. It says tangible item. Now, so my step number one would be that I will first of all identify, is the item tangible in nature? Now, I would say the items can be of three types: purely tangible, purely intangible, or I would say a blend of tangible and intangible. Let's give you some examples and you tell me, is it tangible, is it intangible, or is it a mix of tangible, intangible? Laptop.
Tangible.
Tangible.
I think it is both tangible and intangible. I think it has got hardware and software both. Okay, let's consider that we've got a software in a CD.
Combination.
Yes, it is again combined tangible, intangible. Let's say an item of furniture.
Tangible.
Tangible.
Wonderful. So let me just give you the quick inputs of how I will proceed. I will put across a question in step number 1. Is the item tangible, intangible, or a mix? If you say it is tangible, I go to step 2. If I say it is intangible, I go to IS 38. IS 38 talks about intangible assets. And if you say it's a mix of tangible, intangible, then I will see which is a predominant factor. If the item has got tangible, intangible, we need to zero down and decide which element is predominant. If the tangible element is predominant, we go to step 2. And if the intangible element is predominant, we go to IS 38. Now, in terms of laptop, would you think which element is more predominant in nature?
Tangible.
Yes, it is a well settled issue that in terms of laptop, we always consider the tangible element to be predominant, and therefore we will go to step 2. But what about the software in a CD? Do you think the tangible element is more predominant or intangible?
Intangible.
Intangible.
Correct. So I'll go to IS 38. So I think the first step is pretty clear that you need to first of all see that the item is tangible or intangible in nature. If it is tangible, go to step 2. If it is intangible, 38. If it is a mix, see the predominant level and decide. Right? Now, the clause A is the step 2 and the clause B is the step 3. Now, in terms of step A, it says it is held for use in production or supply of goods or service, for rental to others, or for administrative. I would say the focus in clause A is in terms of the purpose of this item. So your step number 2 would be to consider what is the focus. There are 3 focus areas. You can say there are 3 purposes for which an item can be used. Either it is held for use. By the way, inventory is held for sale. And PPE is held for use. So it is either held for use in production, number 2, rental, or number 3, administration. Now, a little quick inputs at this stage. When you look at a property, the name of the standard is PPE. When you look at a property, I would say there are 2 kinds of property. One is called owner occupied and one is called investment property. Now, there is a separate standard which deals with investment property. That is IS 40. So when you look at a property, there are 2 kinds of property: owner occupied property and there is investment property. Now, very interestingly, when you say owner occupied property, it means a property which is occupied for self use. Like, for example, if you've got a factory building, it is owner occupied. Like, for example, if you look at an office which is meant for administration purposes, it is again owner occupied. Well, let's say, for example, if you purchase a property to earn a rental income or for the purpose of getting a capital appreciation, it is investment property. Now, the interesting part is that investment property is not covered under this standard. It is covered under IS 40. But when it comes to depreciating an investment property, it is depreciated under IS 16. I hope you got my points very clear. Owner occupied property is completely accounted under IS 16. Investment property is accounted under IS 40, but depreciation on investment property is covered under IS 16. And therefore, it is included in the definition. When it says rental, the word rental to others is making a reference to investment property. So which means they never gave a definition of a property. They never gave a definition of owner occupied property. PPE, when we use the word property, are of 2 types. To put it again, owner occupied, investment property. Owner occupied complete accounting is under 16. Investment property is accounted under 40 and 16. 40 mainly and 16 for depreciation. I hope my point is clear. Did you get my point, I guess? Clear with that? Don't worry, notes will be taken later. But am I clear with my thoughts right?
Yes.
Yes.
Okay, so when you look at the step number 2, you need to be clear on that what is the purpose of this PPE. Either it is production, or it is administration, or it is rental. If either of the 3 purposes are there, you go to step 3. And if any one of the purpose is not met, the standard does not apply. Then we go to the step number 3, which is the clause number B. You need to see what is the expected period of use. If it is 1 year plus, I didn't say 1 year. If it is more than 1 year, then I meet the definition. And if it is supposed to be less than 1 year, it's a revenue expenditure. Because if you say that it is a tangible item meant for any of these three purposes, but the expected life is less than a year, then it is supposed to be a revenue expenditure. And again, to remind you, even if you meet the definition, I will not be able to show the asset in the balance sheet. Because apart from the definition, you also need to meet, what are you supposed to meet, by the way?
Definition of an asset.
No.
Recognition
Recognition criteria.
Recognition.
Asset definition is not required because the word asset is not there. It's called item. Unlike IS2, where you are required to meet a definition, there is no recognition criteria. In terms of IS16, there is a definition and there is a recognition criteria both. So once you meet the three parameters of the definition, you need to go to the recognition criteria. And let me also take you to the recognition criteria, which is given in para 7. In terms of the recognition criteria, it says the cost of PPE shall be recognized as an asset if and only if the two conditions A and B is met. And you see the condition number A is, one of the conditions of an asset, that it is probable that future economic benefits will flow. I don't need to prove a legal ownership, but I need to prove that economic benefits will flow. And the condition number 2 is that the cost can be measured reliably. You know what you spent in terms of the asset. So the two criteria for recognition, and you will see in many standards going forward, the recognition criteria is same in almost all these standards on asset related. You should be able to prove economic benefits have got a probability more than 50 and the cost can be measured reliably. Let me just come back on the chain and ask you a few questions now at this stage. Number 1, coming back to that example of a road which is built on the government land. Number 1, is that road tangible?
Yes.
Yes.
Great. What is the purpose of that road? It is production, admin, or is it supposed to be rental?
Enabler asset.
No, but production, administration, or supposed to be rental? Which one of the three?
Production.
I would say administration. Isn't it giving an administrative convenience to the company?
Yes.
People reach their company and they reach their customers, they reach their suppliers. Administrative convenience is working. Is the life of the road going to be more than 1 year?
Yes.
Yes.
And do you think the economic benefits will indirectly flow with a probability more than 50? The road may not give you a direct benefit, but of course, when people reach you easier, the benefits are indirectly going to flow, correct?
Yes.
And the cost can be measured reliably as well. So in this particular case, we can say all 3 and 2 parameters of recognition met. Therefore, it can be taken as an asset in the balance sheet. I hope I'm fairly clear with the definition and the recognition parameters, correct?
Sir, one small query regarding definition clause B. Uh, in accounting standard, it is mentioned as one period. So, if a company follows an operating cycle of less than 12 months, then if the future economic benefit we expect is, let's assume, 11 months, and the operating cycle is of 6 months, even then it will be considered as PPE or what?
Okay. There is no interpretation of period as such given, but the period is not to be interpreted with reference to operating cycle. The period is generally taken as 12 months, 1 year.
Okay.
This is one of the interpretations also which is given in the Indian scenario by the Institute of Chartered Accountants in India, that the word period which is used in the standard connotes a period of 1 year.
Okay.
Okay. So I think let's put this down. I am going to first give you the definition parameters. So KB's 3-step model. So let's have the input in terms of the definition. First of all, let's have the 3-step model. Okay, somebody's got a question. If roads are built in Tamil Nadu, the useful life is less than 1 year. I thought in India, the useful life is much, much more. I don't see the government constructing roads so fast. I don't know how would I answer that in terms of IFRS. But I think roads will generally have a period life considered to be logically more than a year's time. You can repair. You see, let me tell you, if the road goes bad, it's not that you're going to construct the road all over again. You'll repair it. So life is certainly more than a year, but a kind of a repair and maintenance might be required at frequent intervals. That doesn't make the life to be less than 1 year. Right. Okay, so let's consider the step number 1. So in terms of the step number 1, we are focusing on is the item. The word is item. I want to focus that it is not assets. Nowhere the word asset is given in the definition. So I'm going to put that focus. Is the item tangible in nature? Is the item tangible in nature? So I would say there will be 3 permutation combinations in terms of the item. Either we say it is tangible, purely tangible, or we can say it is purely intangible, or we can say it's a blend of tangible, intangible, so mix of tangible as well as intangible in nature. So if I say that it is supposed to be tangible, we go to step number 2. If you say it is intangible, we need to go to IS 38. And if you say it is mixed, we need to see which element is predominant. We need to see which element is predominant in nature. So like we said, in terms of laptop, the tangible element is predominant. So we need to reach a conclusion which is predominant. If you say the tangible element is predominant, then we need to go to step 2. And if you say the intangible element is predominant, then in that particular case, IS 38. So first step in any case is not going to give any kind of challenge as such. Right, if you're done, let's go to the step number 2. Okay, done. So we go to the step number 2 then. And in terms of the step number 2, now the focus is looking at the purpose. The focus is looking at the purpose. And in terms of the purpose, either of these 3 purposes needs to be there. And I think at this stage, I'll also like to put a small little inputs at this end, that when I am looking at a property, just for your reference, the property we said is of 2 types. When you look at the word property, either it is owner occupied, or it is supposed to be an investment property. So we've got owner occupied property or we've got investment property. Just to be very clear, when I say owner occupied property, the examples in this case could be a factory building. The example in this case could be an office building. And investment property is something which is for the purpose of earning a rental income. It is earning a rental income, or it is meant for a capital appreciation. You invest in a building with the objective of earning a rent or a capital appreciation. And to put this clear, owner occupied property is completely accounted under IS 16 and this is accounted under IS 40, but we can say for depreciation, IS 16 applies. So investment property is only depreciated as per this standard. Otherwise, it is completely accounted under IS 40. So the purpose is either production, that means you use it for production of goods and service, or it is administration, or it is rental income. So when I say rental, the reference is to an investment property. So we need to prove that either of these purposes are there. So we can say either it is a yes or it is a no. So if you say it's not meant for any of these 3, neither production, nor admin, nor sale, then I would say standard is not applicable. If you say a yes, we go to the step number 3. And then it comes to the step number 3, And in terms of the step number 3, we need to see the life. So we need to see that it is expected to be used. It is expected to be used for what span of time? So if you say that it is 1 year plus, or if you say it is 1 year or less, if it is 1 year or less, what should be the course of action? Less than a year,
OPEX or prepaid?
revenue expenditure. We're going to charge the expense in the P&L because the benefits are not for long, it's revenue. And if it is 1 year, can I show that as an asset in the balance sheet? If it is 1 year plus, will I be able to show the asset in the balance sheet?
Yes.
No. You need to go to the recognition criteria. I intentionally asked that question. So you meet the definition, but you still need to apply a recognition criteria as well. So let's now put down the recognition criteria. That what is the recognition criteria? So there are 2 criterias for recognition. So we just need to quickly keep in mind the recognition criteria is future economic benefits are probable. The future economic benefits are probable. That means there is more than a 50% chance of getting a benefit, and the cost can be measured reliably. The cost can be measured reliably. If you can measure the cost reliably, after these conditions are met, then it can be reflected as an asset in the balance sheet of the company. Right, so this is my block number 1. It gives us a conceptual understanding of the definition, and on the recognition criteria, you meet the definition 3 parameters, you meet the recognition 2 parameters, and all the 5 are met. It appears an asset in the balance sheet of the company. Okay, let me know if you're done. Then let's go to the block 2.
Just a minute, sir.
Yeah.
So could you repeat the 50% plus part?
Yeah, the economic benefits which you are going to get, there should be a more than 50% probability that benefits will be obtained directly, indirectly.
Okay, thank you, sir.
You're welcome.
So this rental part could also include the equipments purchased as an asset and given on rental to the customers, right?
No, investment property will be only with reference to building.
No, I'm
I,
asking regarding the rental part in the definition criteria of IS 16 only.
to my mind, I think rental is mainly a reference to investment property. I guess if you're using the machinery to give it on rent, otherwise IFRS 16 would apply.
Yeah,
Then I don't
that's what
think.
actually I was asking. If I have procured an equipment, I am recognizing it as an asset with me, and I am giving it on rental to a customer for, let's assume, 3 years. Then I'll be like taking the possession back of that equipment, and I'll be giving that same equipment to another customer for, let's assume, another 3 years. So that equipment giving on rental part is also covered under this IS 16, right?
No. Actually, you see, in any case, if you're giving a rent, then you would be reflecting it as a RU asset. You'll be completely under IFRS 16 and not under 16, IS
No,
16.
I am saying I am giving it to on rental to customer. I am not taking from on rental to from any lesser. When I am taking it on rental from a lesser, then it would
For
be an
your
ROU asset
convenience.
for me, right?
No. If you're taking something on a rent and it's a finance lease for you, right?
No. I am asking for a condition wherein I am giving the equipment which is mine on rental to customer.
Still, it doesn't become a case of IS 16. You see, if you're going to give an equipment on a lease, you need to derecognize and show a lease receivable. You cannot
Okay.
continue to show the asset in the balance sheet.
Okay.
So in any case, to my concept, this rental cannot be a case of any kind of machines and all. I think the reference is purely to investment property. I'll tell
Okay.
you the reason why. I have a logic also for that. If you look at IS 40, they've given two definitions. They've given owner-occupied definition and they've given an investment property definition both. If you look at the owner-occupied definition, the rental part has been deleted.
Right.
So when they've deleted the rental part, that means they were very clear that the rental part relates to investment property. So when they give an investment property definition, they retain the rental part. So owner occupied is focusing on production admin. Investment property is focusing on rental. And when you merge the two, it's called property. So
Right.
when we look at the definition in terms of IS 40, I think we get the essence that this rental is only with reference to a building. That is investment property. That's what I feel is the concept.
Okay.
Yeah. Okay. So this is one input. Now let's come to the other area of discussion, that is block number 2. Now, before I go to the block number 2, I have something to ask you. How comfortable are you in terms of the other comprehensive income concept and SOKI? How comfortable you are with the concept of other comprehensive income and in terms of SOKI, statement of changes in equity? There has been a pin drop silence on my question. So what do I presume? You're very comfortable indeed. I'll presume to my convenience. Your silence means you're expert on the area. Thank you. Okay. So I guess I assume the silence to be good. So let's go to the block number 2, that is the measurement aspect. Now, when it comes to the measurement aspect, I said we're looking at two things. One is we're looking in terms of initial measurement, and one is we're looking at a subsequent measurement. So let's see what are the measurement principles given in IS 16 with reference to initial and a subsequent measurement. Now, when you consider initial measurement, the standard is very clear that you are going to consider the PPE at cost. Here again, the input comes into play, that what is included in the cost and what is excluded in the cost. So we need to understand that what is the inclusion exclusion. So we're going to make a separate chart on this area to understand what is included and excluded in terms of cost. Okay, I got two inputs so far, not clear on the concepts, not clear. Only 2 people gave the answers. So I think the rest of the people are very clear on the concepts. I see, most of you are very apprehensive of giving answers or saying something. I'll tell you one thing. The clarity will always keep dividing in life. And the problems will keep multiplying in life. The day you study in the class and you feel that you're clear, by the next class you'll say, oh my God, I'm having problems. And the day when you say you've got problems, you will say, I didn't even understand the topic. So get into the habit of asking questions. Don't fear. Don't think, don't get, with the fact that, people are judging you. Nobody judges anybody in life these days. So if you don't know it, be candid, you don't know it. If you know it, you know it. So there's nothing to feel afraid. If anybody is judging you, I feel, these days people only judge you in all these forms and all. Let people judge. You look at people in social media, if somebody puts something, people are judging him and giving comments. I don't care about these things at all. Okay, anyway, so this is initial and then this is subsequent measurement. I have a gut feeling. Shall I say something? Shall I take the honors of saying something at this stage?
Yes, sir.
My assessment, because I can only, see the answers coming in and, I get the answers and that's how I make my assessment, because most of the time I see the cameras. I think 2-3 people put their cameras on, rest are still, putting the cameras off. I don't know what kind of apprehensions you've got. Anyway, that's perfectly okay. Don't want to put your cameras on. That's perfectly okay. So, my assessment tells me that, whatever we have covered so far, it must have been a bit of a cultural shock to you. Say yes or no.
Yes.
The kind of inputs I've given you sometimes might have contradicted in terms of a previous concepts and all. Few things, must have been, tell me frankly, because, as we're going to move ahead, trust me, you definitely going to get some shockers.
Yes, sir. Sir,
Yes, sir.
like some of us, we are from 9 exemptions and we haven't studied this far. So the major problem is there also.
That doesn't make a difference. Actually, I'm not. You see, when I asked you that, do you know about OCI? You should have said point blank, I never studied OCI. Why are you feeling apprehensive? If you don't say anything, you see, I can't see your faces. If it is like an offline class, you can see the reaction of the people and you can make out everything. Here, the best part is that people don't speak. Your tone also tells a lot of things. Nobody wants to speak much, number one. Nobody wants to put the cameras on. On the chat box, do you think I'm a great astrologer in life who's going to look at the chat box and decide things about your feelings? You need to be proactive in terms of things. It's a two-way communication. The times have undergone a massive change now. Now is the time. Why do you think I'm using this kind of a setup in terms of digital board? It is not only for my experience of teaching. Trust me, sitting down on a laptop is the most lethargic kind of teaching one can do. And I feel, if you want to do energetic kind of teaching, you must have the space to walk in and the space to speak in as well. So the idea is to give you a full flavor of, offline teaching as well, where we interact well. So I expect a little more interactions coming at your end. Because if you are going to remain silent, good for me, I will assume half of the things and move ahead. Okay, sometimes we do not know answer and sometimes we do not understand the question itself. That's why there is a delay in responding. Please be fair and frank. There is nothing. Sometimes you feel, fearing that I didn't understand the question, ask it. There is a saying which says, if you are in a problem, you need to ask. There is a Hindi phrase which says, बिना रोए माँ बच्चे को दूध नहीं देती है. आपको क्या लगता है मैं माँ हूँ आपकी? Okay, so let's take it ahead. So be a little proactive in terms of asking questions. There is nothing. Don't feel apprehensive what other people will think. If that be the case, I have asked so many questions to my, teaching people, teaching teachers I've been, who have taught me. They got annoyed in terms of the number of questions I ask. I guess you must have wondered that I've been asking so many questions from day one. I'm in a very good or a bad habit, or what do you call it, asking a lot of questions. And even if you answer them or not, even if 10 people answer, I will still keep asking questions. Habitual. Okay, so let me put the question back to you. How many of you are comfortable in OCI and SOKI? Last inputs to be given. Are you comfortable in OCI and SOKI? Say yes or no. Don't say I didn't understand the question.
No, sir.
Somewhat.
Good. I wanted to actually hear that, though we don't understand that. In SBR, you need to understand this concept, and I'm going to make you understand this concept because I'm going to spend good time on the understanding of this. Conceptual clarity is at the highest priority in SBR. My experience in terms of teaching this subject is, people have a very good habit, they will do 3-4 questions practice with you. जब तक आपको रट नहीं जाएगा क्वेश्चन प्रैक्टिस करो. No, that's not my idea. If you understand the concept, even if you do a single question, you'll get clarity. You do 10 questions, and if you don't know the concept, you'll still never get a clarity. I'll give you the concept of OCI SOKI in great detail. You will understand. I'll give you a bit flavor today only. I'll give you a bit flavor right now. Okay, so on the subsequent measurement, the standard says that the company has got an accounting policy choice. The standard says that the company has got an accounting policy choice, where the company can either consider a cost model for the purpose of measurement, or the company can consider what is called a revaluation model. So the company can either choose a cost model or the company can choose a revaluation model. So this is a summary in terms of the measurement aspects. That initial measurement is cost. Subsequent measurement depends upon the choice of the company. They can choose a cost model or they can choose a revaluation model. Now, in order to understand the revaluation model, it is important to understand OCI. So I'm now going to spend some time with you. I'm moving out of the standard and I am going to explain you the concept of other comprehensive income. So please hear me very carefully. The next 15 minutes or so is going to be very crucial. You'll get the concept, 100% guarantee, terms and conditions apply, how open you hear the inputs. Get ready. So to make the concept simple that you can understand it clearly, I'm just going to give you some basic inputs to get the concepts clear. You know, I always tell people that this is what you've done in school and college. And I always tell people that this is what you're doing in ACCA when you study IFRS. Please hear this very carefully. You'll get the larger concept because I'm going to create a base today and I'm going to work upon this base slowly and steadily. So in school, what you used to do, you used to make a profit and loss account. And what we used to do, we used to actually consider this profit and loss account as a dustbin. Trust me, we used to actually consider the profit and loss account as a dustbin because every income and every expense used to be taken in the P&L. You all know that a trial balance of the company is got an asset, liability, income, expense. The asset liability goes in the balance sheet making and the income and expense goes in the P&L. So in this particular case, what we used to do, we used to consider every income in the P&L and we used to consider every expense in the P&L. That's how the profitability statement used to be computed. Let's assume some figures for a better understanding. Let's say your income is to the extent of 25 lakhs and let's say the expense is to the extent of 10 lakhs. So I guess if I want to calculate a profit in this particular case, can I say 25 minus 10, the profit is 15 lakhs. And let's consider the company has got number of shares, number of equity shares in the company is, let's say, 2 lakh shares. So what is the earning per share of the company? 7.5. Did you get the left hand side? Are we clear on the
Yes.
left hand side? Correct.
Yes.
Now, in terms of IFRS, this is not the way. The standard setters had something very clear in mind. And they said that when you make an income statement, you should divide the income statement in two parts. One is a P&L and one is other comprehensive income. So they said that we're going to divide the profit and loss income statement in two parts, profit and loss and other comprehensive income. And they decided that certain incomes and expenses will enter in the P&L and certain incomes and expenses will enter the OCI. Now, don't ask me at this stage that which income and expenses will enter the P&L or which will enter the OCI. That's what we're going to develop right now. But just assume on a mathematical front that certain income and expenses enters the P&L and certain income and expenses enters the other comprehensive income. So in the same example, let's assume in the same example that out of this 25 lakh, let's assume 18 lakhs is taken here and let's assume 7 lakhs is taken here. Let's not get worried on what is the amount taken here and what is the taken here. Let's assume that out of 25 lakhs, my standards tell me that 18 lakhs should enter the P&L and 8 lakhs should enter the OCI. And let's consider that the entire 10 lakhs should enter the P&L and nothing should enter the other comprehensive income. Now, in this particular case, if I calculate the profits of the P&L, 18 minus 10, the profits is supposed to be 8 lakhs. And if I calculate the profits in the OCI, 7 minus 0, that profit is equal to 7 lakhs. And if you add the total profit 8 plus 7, the total profits in this case is 15 lakhs. A very simple and a straightforward question. You see the profit here is 15 and you see the profit here is 15. Is this by chance the same or is this got to be the same?
got to be the same.
Yes, it is on a mathematical level what I've done. I basically, split certain income and expense in another part. Here you've taken all the income and expense in one P&L, and here you're splitting something in the P&L and something in OCI. The total profits would remain the same. So in any case, by splitting, the standard setters didn't achieve much, but they have something very interesting to watch. Now, in this particular case, if I want to calculate the EPS of the company, when you go to calculate the EPS of the company, I will consider only this 8 lakhs. What enters in the other comprehensive income will not be taken in the EPS calculation. What enters in the other comprehensive income is not to be taken in the EPS calculation. So I will take this 8 lakhs profits in the P&L divided by the number of shares 2 lakh, and the earning per share becomes 4. Did you get the maths?
Okay. Yes, sir.
Yes.
Now let me put some few inputs to you, and on the basis of what you've already watched, let me give you some inputs and please give me an answer on that. I'm going to make 4 statements. You need to vouch me on that statements. What enters in the P&L, does it impact the total profits of the company?
No.
Are you sure?
Yes.
Yes.
8 plus 7 is 15. Let me put it again.
Yes.
What enters in the P&L, is it impacting the total profits of the company?
Yes, sir.
Yes, of course it is. Okay, next question is, what is entering in the P&L, is it impacting the EPS of the company?
Yes, sir.
Yes.
Yes.
Third, what is entered in the OCI, is it impacting the profits of the company?
Yes, sir.
Yes.
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 But what is entering in the OCI, is it impacting the EPS of the company?
No.
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 So
No.
let's get this very straight. Whether you take the item in the P&L or whether you take it in the OCI, can I say profits are affected, correct?
Yes.
Yes.
But when you take it in the P&L, the EPS is affected, but when you take it in the OCI, EPS is not affected.
Yes.
So my
Yeah.
focus point is very clear that OCI is a creation because I don't want the EPS to be affected. Make sense?
Yeah. Yes.
Now there is one very important input. Let me put the same thing in a different style now. Let me put the same thing in a different style. Can I say, if as a standard setter, I want your EPS to be affected, where will I suggest you to put it?
In the P&L.
P&L.
And if as a standard setter, I feel no, I don't want your EPS to be affected, where will I put it?
OCI.
Right? So let's keep this in mind. Now what I'm going to do, I'm going to give you a basic principle of other comprehensive income. Though we're going to see later a lot of exceptions coming on that basic principle, but to begin with, let's create a simple chart. I'm going to give you some situations and you need to decide on logical level if you feel that the earning per share should be impacted, then say P&L. If you feel no, it doesn't make sense to me that the EPS is impacted, then you say OCI, right? Let's consider this is P&L and this is OCI. If a company gets an unrealized gain, what do you think? Should I allow the EPS to go up because of the unrealized gain? Let's say you've got a building
No.
and that building was bought at 5 lakh rupees and now the market value of the building, the fair of the building is 8 lakh rupees. Should I allow that gain to affect the earning per share, or is it something which is unrealized?
Unrealized.
Yeah.
Not
So
affected.
where should I put
OCI.
it? In the P&L? OCI. OCI. Makes sense?
OCI.
Let's say if there is an unrealized loss, do you think it should impact the EPS? It's a loss, but it's not realized as of now.
No.
No.
I will tell, yes, my EPS should be affected. Reason. You follow the concept of prudence. We always tell in accounting that we will take into account prospective loss, but not a prospective gain. So if there is an unrealized loss, isn't that a prospective loss? Shouldn't that be taken into account? And shouldn't that be affecting the EPS? Yes. So the basic thumb rule which is coming to the mind is, if you get an unrealized gain, OCI. If you get an unrealized loss, P&L. Make sense?
Yes, sir.
Let's now consider that there is a realized gain or there is a realized loss. Do you think a realized gain should be impacting EPS?
Yes, both should
Yes.
impact.
And what about a realized loss?
Yes.
Yes.
Yes, sir.
So I think I have reached a consensus that the standard setters at one basic thumb rule at the back of the mind, that OCI is a creation where I will tell the company to park their unrealized gains, because I will allow them to increase profits on account of unrealized gain, but at the same time I don't want them to increase the earning per share.
Yes.
But let me tell you that this particular entire chart has got a lot of exceptions which we will discuss as we come to the standards. So there are going to be a lot of exceptions coming in, but this will remain my basic thumb rule. So when I will do a discussion on a particular aspect, I will ask you, okay, if there is an unrealized gain, where do we park it? And there is an unrealized loss, where do we park it? So the thumb rule which is there at the back of the mind is that if you get an unrealized gain in the OCI, rest all in the P&L. Got the point?
Yes, sir.
Okay, somebody's got a question. So will there be tax to be paid on the income in OCI? Well, if you're looking at the income tax, or are you looking at a deferred tax? If you're looking at a deferred tax, we'll discuss in IAS 12. But if you're looking at income tax, accounting profits are never a base to pay taxes to the government. So as far as the income tax is concerned, the calculation of income tax is based on a taxable income, which is based on the tax provisions. So what you're parking as OCI is an accounting concept, nothing to do with tax. But if you look at a deferred tax, that we'll discuss when we come to IAS 12, right? Okay. Now with this inputs in hand, I would now like to come further. So I will do one thing, not as of now. I'll do that, of course, in the next class. I will give you a very comprehensive example where I will give you a walkthrough in terms of other comprehensive incomes and all. The next class is going to be very interesting indeed, because I am going to give you a lot of walkthrough in terms of OCI understanding. Of course, we will keep within IAS 16 concept, but we need to build this concept slowly and steadily, but we'll get that base. Now, if I come back to IAS 16 and I look at the subsequent measurement, one thing which I want to clarify at this stage itself, in terms of the subsequent measurement, the standard setters decided on two things. Now watch this logically. They said, we are looking at number one, is it a first time? Is it a first time increase? When you revalue the asset, you get a gain. Or is it a first time decrease? When you revalue the asset, you get a loss. Let me put this question now to you. If there is an unrealized gain, where do I put this, P&L or OCI?
OCI.
Yeah.
Beautiful indeed. I'm going to give a credit to other comprehensive income. And if there is a decrease, it's an unrealized loss, where do you put it?
PNL.
PNL.
That's right. I'm going to debit the P&L. So I think my chart is still working, correct? My chart is still working, that there is an unrealized gain in the OCI and there is a realized unrealized loss in the P&L. But then the standard comes to the play that if there is a subsequent change. Now I would advise that when you revalue the asset for the first time, you get a gain in the OCI, you get a loss in the P&L. But when you do it for the next time, it is what is called a cumulative approach. So you need to put a very simple little question now. When you do a subsequent change, you are going to put a very simple question. The question is, if there is a subsequent increase, if you're saying there is a subsequent increase, you need to put across a question, did you debit the P&L earlier? Mind the question carefully. If there is a subsequent increase, not first time, subsequent increase, you're going to put a question, did we debit profit and loss account earlier? The focus question needs to be very clear that did I debit the P&L earlier? Now let me tell you, there are two ways of accounting. One is called a discrete approach. A discrete approach means each situation is considered separately. And another one is a cumulative approach. You are going to see what you did in the past and you're going to see what is done as today. So the standard is based on a cumulative approach. Now watch this. So you will say that if there is a subsequent increase, did we debit the P&L earlier? If you say yes, I debited the P&L, I will credit P&L to the extent. I will credit the P&L to the extent of earlier debit. Is this making sense to you?
Yes.
Because in this particular case, you said you debited the P&L, and if it is a cumulative accounting you need to do, you will say, let me first rectify the past. So if there is an increase, I'll say, don't take it to the OCI. You first credit the P&L to the extent of earlier debit. But let's say if there is still an excess, what do you say, where should I take that?
Then
OCI.
unrealized gain in a
OCI.
Yes, then I will credit the other comprehensive income. So the treatment is slightly different when you do it for the first time and when you do it for the subsequent time. Okay, if I say no, I did not debit the P&L, would you like to give me the treatment?
To OCI.
Right? I will simply credit the other comprehensive income. So your focus needs to be very clear that if it is a first time increase, OCI. If it is a second, third, fourth time, any time further increase, you need to be watchful because we need to do a cumulative treatment. So increase means go back and see, did you debit the P&L earlier? If you debited the P&L, you will first give a credit to nullify the previous accounting and then proceed to the OCI. Let's see the other one now. Now, similarly, in this particular case, when you say that there is a subsequent decrease, you're going to put a question to yourself if there is a subsequent decrease. Would you like to make a guess what question you're going to put across? If there is a subsequent decrease. Any guess?
Has
PNL.
there been a previous increase?
Yes. So
Credit
I
to
will
OCI.
say, did we credit OCI earlier? I will say, okay, did you credit OCI earlier? Because in this particular case, if you got a decrease, I'm not going to put it in the P&L. I'll say, okay, if you did a credit to the OCI, let me first reverse it. So if you say a yes, then what I will do, I will debit OCI to the extent of earlier debit, correct? To the extent of earlier credit. So if there is any earlier credit which is done, you're going to first debit the OCI. But let's say if there's still any excess which you get, what do you think you'll do with the excess?
Debit P&L.
Deb-
Wonderful indeed. I will debit the profit and loss in this case. So the focus needs to be very clear that when you are putting that question across, your focus needs to be very clear. First time increase OCI, first time decrease P&L, subsequent increase, did I debit P&L? Subsequent decrease, did I credit OCI? And if you say no, I did not credit the OCI, then what do? Simply debit the P&L.
Debit PNL.
So this is the accounting treatment which is suggested for a subsequent measurement, that is OCI. I've just given you a very basic flavor of OCI right now. I'm not giving you any deep understanding on OCI. This is just a very basic inputs on how the OCI works, right? Okay, I'll take a very simple example to, I think, give you the permutation combinations on this chart before we end. So let's do one thing with this understanding. Let's give you a simple chart. So let's consider that the asset is as a cost to the extent of, let's say, 5 lakh. I'm ignoring depreciation. Let's say first time there is a revaluation at 7 lakh. Or let's say there is a revaluation at 3. Would you like to tell me where will you put this gain of 2 lakhs?
OCI.
Correct.
OCI.
So we will credit 2 lakh rupees in other comprehensive income. Makes sense. Would you like to tell me in this case, where will you put the loss of 2 lakhs?
Debit
Debit
P&L.
PNL.
PNL.
Correct. I'll debit the profit and loss. I think this is logical first time. Let's create more combinations. Let's take 2 permutation combinations for a subsequent treatment. Let's say in this case, it jumps to 10 lakhs, or let's say it drops down to 4 lakh. Let's say in this particular case, subsequently it moves down to 2 lakhs, and let's say it pushes to 6 lakh. Now watch this carefully. We need to get the focus very clear. Okay, let's, I think, put this question. This is increase now. Question. There is an increase now. Question.
3 lakh in OC.
What will I say? Did I credit P&L earlier? Correct. Somebody's playing Christmas Carol. Okay, so in this particular case, sorry, when there is an increase, I'll put across a question. Did I debit the P&L earlier? Am I right?
Sir.
No.
So I did not debit the P&L. So where do I put that 3 lakhs now?
OCA.
Correct. Now let's consider 4 lakhs. It comes down to 3 lakh. Here again, if it comes down, what is the question? If it has come down, what is the question?
Debit PNL by 2 lakh.
So I'll say, first of all, did you credit OCI earlier, right? The focus is, did I credit the OCI earlier? I did. So what I'll do, I'll debit 2 lakhs in the OCI, and still there is a decrease of another 1 lakh. Can I say 1 lakh is debited to the P&L? Correct? Now let's see the other one. From 3, it again goes down to 2 lakh. What is the question? It's a decrease. So what question will you put across? It's a decrease, subsequent decrease. Did I credit the
Credit the
OCI
OCA.
earlier? I did not credit the
No.
OCI earlier. So where do I put that 1 lakh debit to P&L? Now let's come to the next one. From 3, it became 6. So there is an increase. Question. What is the question? Did I debit the P&L earlier? I debited the P&L earlier. So how much P&L did I debit? 2 lakhs. So what should I do? Credit the P&L by 2 lakhs, correct? We credit the profit and loss by 2 lakh rupees. And there is still another 1 lakh to go. So where will I put that 1 lakh to?
OCA.
OCI.
Correct.
Credit.
So this takes care of all the permutations, combinations which can arise in this particular case. I hope I am clear with the picture.
Yes, sir.
Now, there is more to go on IS 16, but I've just given you the inputs on the revaluation model. My inputs in terms of what is included, excluded, and more details on the revaluation models are still pending. Standard is not complete. We're still left with the standard. But I think that's all what we're doing right now. And again, to remind you, tomorrow I'm not taking a class. So I'll be meeting you in the next week. So we'll see how do we, take care of this particular class. But tomorrow is an off for you. So please don't log into the class. I've already shared my number as well. And I'll create a WhatsApp group. I've already shared that in the chat. And I'll just maybe try to make a WhatsApp group so that if you want to ask any problems during the week or something, we are connected on that. Right, friends? Any questions on your side?
So these permutation combinations needs to be judged for each component of PP separately or as a combination, as a group.
No, you have to track it for every asset separately, every PP separately.
So, can you recommend how should we go about practicing what is being taught in the class? Should we just go by the notes, or are there any questions from Kaplan or?
No. As I suggested in the very first class, Did you attend the very first class?
No, sadly, sir, I haven't attended the first and the second. So yeah,
Please
that's
go to
the
the first class. I spent a good time,
yes.
giving you a strategy on
Okay.
terms of how you need to go, because I've
Okay.
given the references, LMS and all those things. So in any case, you'll watch the class. So once you see that, I've
Okay.
spent the initial half an hour or something to explain the.
Okay. No, absolutely, I will. Whether just one follow-up question, sir. Are were there any notes shared in the first and the second class?
On
Just
the LMS, yes. They're on the LMS.
LMS. Okay. Thank you.
You're welcome. Right, friends, I think that seems to be good, sir. Also, the questions bank is not opening. Can you ask them to reload? Is anybody else also facing a problem in the question bank? I think I tried, it was opening to what I remember, because when I was uploading the notes, I was just trying to check the other tabs. I'll still see, but I think it was working. Maybe try it again. Otherwise, we'll see. Okay, not an issue. I'll also check on my end. Once I upload the notes, I'll check it out. If there is a problem, of course, I'll update them. Not an issue. Right, friends. So I think that's all for the day. I'm going to see you in the next week. Please keep revising things. See you in the next week. Thank you. Bye-bye. Take care.
Thank you, sir.
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 Much.
Thank you,
See
sir.
Thanks. Bye-bye.